Private credit or non-bank loans have a chance of default or going into default as high as 15%. This is UBS's forecast. Some people might think, oh, non-bank loans could default? Is it really that serious? And if it actually goes as high as 15%, just how bad is that? If you don't know, that's okay. But if you watch this clip, you'll understand exactly what it means when we talk about non-bank loans and what it would mean if defaults hit 15%. That would be extremely serious, and there's a real chance it could happen. This could affect assets all over the world because non-bank loans or private credit, this sector is huge. It's grown so fast that now it's worth about $2 trillion. So could it collapse because of loan defaults? In this clip, we'll take a look at who they're lending to the most. And just a little spoiler, they lend the most to software companies. Yes, it's the software sector that's being dragged down across the board by AI. And if anyone thinks, well, that's outside the banking system, so my bank is safe, that's not necessarily true. I'll explain step by step how this could affect different parties. And as for private credit, could it become the next bad debt crisis in the AI era? Let's dive into the data in this clip. Could private credit become the next bad debt crisis? You can follow Time Money Monster on this QR code or support the Time Money Monster channel very easily. Hit like, share, and leave a comment to chat with us. You can also save it to watch later. But what I really want you to do the most is, please subscribe for me. If you've already subscribed, you don't need to do it again. If you haven't, just hit it once. That's enough. That way, when I post a new video, we can meet again, right? Sounds good? Thank you. All right, let's talk about the situation with private credit or debt outside the banking system. How bad can the risk of default get? Just how serious is it? I'll break it down for you step by step using numbers and charts. Let's start with this first chart. Let's take a look at the most recent quarter. Private credit companies have seen their revenues drop sharply. We're talking about a minimum decline of 30%. And in some cases, the drop is even steeper, over 50%. That's a huge hit. Starting right here with Bluewell, their revenue in the latest quarter dropped by 54%. That's more than half. This is an extremely severe decline. In fact, things are so bad that Bluewell has officially announced that retail investors are no longer allowed to withdraw their money. When we saw this news, we thought, if we were investors in Bluewell and saw this, we'd wonder, is this allowed? If they announce it, it must be, right? But it's not that simple. The company still must repay investors. So Bluewell is saying, retail investors can't withdraw now, but will sell assets and pay you back in installments. Hearing that, investors might feel more at ease. Or maybe even more panicked, actually. In a situation like this, it means the company isn't doing well. It's in a crisis. They're planning to sell assets, but will they really be able to sell them? Or will it be at a huge discount? If they sell at a loss, how much money will actually come in? All these thoughts come up. Honestly, if you've been following your investment closely, you would have noticed warning signs from Bluelaw for a while now. If you compare Bluewell's stock to the S&P 500, you'll see that they've been going in completely different directions for a long time now. The S&P 500 is the index of the top 500 large cap stocks in the US, right? It's still been able to move up, at least it was still rising before, but Bluewell has been dropping, going deeper and deeper down for quite a while now. And then, looking at private credit, KKR is down 40%, Apollo Global is down 30%, Rees Management is down 37%, and then Black down 34%. Not to be confused with backlog. Jamie Dimon, the CEO of JP Morgan, even came out and said that if something outside the system like this collapses next time, when it happens, it's going to be unusually severe. That's because of the sheer size and the rapid growth of the private credit industry in recent years. It's been growing extremely fast and aggressively. And it's grown to become huge, really, really big. The private credit industry grew from $300 billion in 2010 to $2 trillion at the beginning of 2026. That's a six-fold increase. Why did it grow so fast? The answer isn't hard, because it offers excellent returns, really outstanding returns. Over the past 20 years, the private credit industry has been a market that delivers high rates of return. Just look at this chart. It's a market that provides great yields. It's even better than the S&P 500, better than the MSCI, or even global stocks. So why does private credit deliver such good returns? It's because there's a lot of leverage involved. Leverage means borrowing more to invest. So even if you only have this much capital, you can amplify it with leverage. The more you can borrow, the more you can invest, and if things go well, your returns are much higher. We can see that the proportion of leverage in private credit during the years 2010. From 2001 to 2018, the average leverage was about 4.5 times. But when we get to 2022 to 2055, wait, that's not right. From 2022 to 2025, why is leverage increasing so fast? The borrowing for investment has gone up. At first, 4.5 times seemed like a lot, but in the period from 2022 to 2025, it's jumped to 6 times. So this 6 times leverage looks something like this. Editor, please put up the graphic here. Let's say there's an investor. So there's an investor who lends money to private credit, right? Multiply that by 6. So draw 6 lines, 1, 2, 3, 4, 5, 6, going to 6 different companies like this. This means that the incoming money isn't as much as the outgoing money that's being lent out to each company. So if any problem arises that affects cash flow, liquidity issues can happen like. It's frustrating, honestly. And yes, what's happening right now is an economic problem. The economy isn't doing well. There's been a lot of lending to software companies, but those software companies aren't delivering great returns. So what's happening is basically a liquidity problem. And when liquidity issues start to happen, the people who are lending to private credit are the investors, right? The problem is if the investors start not wanting to invest anymore, but instead investors want to withdraw their money. And this is exactly the starting point of a domino effect of problems. If you ask about private credit companies that receive a single stream of funds and then lend out 6 times that amount, if suddenly investors want to withdraw their money, will there be enough to pay them back? The answer is there will be, but definitely not the full amount. Now, let's take a look at this together. Given that this is the current situation, why exactly does UBS predict that private credit could see default rates as high as 15%? Let's take a closer look at which specific industries private credit lends to the most. We will examine the private credit portfolio by industry using the second quarter 2025 data from the latest research reports at Barclays. The industry that private credit companies lend to the most, shown here by the white line, is the sector of software development companies. All right, number 2, represented by the red line, is commercial services. Number 3, the blue line, is commercial products. And number 4, the yellow line, is the healthcare industry. Now that we've looked at the portfolio, let's highlight the white line, which is number 1, software companies. It's not surprising that private credit invests and lends the most to software companies because from 2017 to 2021, software has consistently been one of the industries that has delivered the highest and fastest returns. Even up to now, if we go back to the private credit portfolio chart, you'll see that software makes up about 20% of the private credit portfolio. That's a lot. 20% is 1/5. And this 20% that makes up 1/5 is a significant number. The fact that 20% of the portfolio is in software, do you know what that matches up with? It matches the proportion of bank portfolios back then, commercial banks during the 2007 subprime crisis. In 2007, during the subprime crisis, the largest portion of commercial bank lending, about 20 to 25%, was in mortgage loans. And that crisis happened because of bad mortgage debt. So in this clip, since 20% of the private credit portfolio is in software and AI are kind of linked, right? In this clip, you don't even have to mention the term AI bubble at all. Just let the graph do the talking. One look at the graph and you get it. The S&P software industry has dropped sharply right now. If you want to see the connection, you'll notice that the graph for the software industry and private credit, they've both dropped in the same direction. So why do they drop? It's because they're linked like this. Private credit lends to software companies, which it's also related to AI, right? And lately, both software and AI have been dropping. So the people who lend to them are going to drop as well. But actually, the drop hasn't really happened yet. Not a real crash. But if it does crash for real, will the AI industry drag down software and private credit together, like pulling everything down at once? The answer is it could happen, or maybe it won't. It depends on. It depends on how scared investors get. Will the fear in the AI industry be so intense that they pull their money out? And if they do pull their money out, you have to ask, how scared are they? And how much money will they withdraw? Because if investors get really scared and it turns into a trend, like, oh, everyone withdraws their money all at once, then it won't just be AI, software, or private credit that gets hit. If investor fear leads to a mass withdrawal, then no matter what industry it is in the world, if investors have money, they can do anything. Let me go back and give you a real life example that's happening right now with a private credit company called Blue Owl. Investors are starting to get really scared and are beginning to request withdrawals. But Blue Owl is probably worried that if they allow unrestricted withdrawals, the company might collapse. So they've announced that retail investors are permanently prohibited from withdrawing their money. But at the end of the day, customers' money is still customers' money. As long as Blue Owl wants to keep operating and maintain the trust of its clients, they still have to find a way to return the money to customers no matter how. Blue Owl said they would gradually sell off assets to pay it back, right? The amount Blue Owl has to return to customers is $1.4 billion, which is about 30% of Blue Owl's assets. Keep that 30% figure in mind. We'll come back to it at the end of the video. So you get the idea. Blue Owl needs to pay back its debts, so they have to sell off assets. But selling assets during a bad economy means selling at a time when prices aren't good. They even have to lower the price of their assets. Blue Owl has to sell these assets on the secondary market, right? So there will be a discount, currently around 20 to 35%, which is a lot. But even though that's a big number, this 20 to 35% drop is just the discount at the beginning phase. It's not even the worst yet. It's still just the starting zone. That means if things keep going like this and nothing gets better, or if things get even worse, investors will get more and more scared and demand even more withdrawals than before. Then there's a chance that private credit companies will have to sell assets to pay back clients, selling at even bigger losses. And if anyone thinks, well, it's just private credit, right? Debt outside the banking system. $2 trillion, right? It would probably just be limited to that circle, not that big. But let me show you whether it's really that big or not. Let's take a look at which companies private credit actually lends to. You already know, right? Most of them are software companies. Now, let's look at the investor side. Who are the investors in private credit? It's definitely not just retail investors. So who exactly are the major players currently investing in private credit? Well, it is actually the commercial banks. So let's take a much closer look at what specific proportion of private credit these commercial banks are lending to. According to the official data provided by the Federal Reserve Economic Data, from the year 2015 to 2026, commercial banks have lent a massive total of $1.8 trillion to various non-bank financial institutions. Wow, did they really lend that much to private credit? No, not exactly. The $1.8 trillion is the amount that commercial banks have lent to non-banks in general, basically the shadow banking system or other financial institutions that aren't banks. It's not specifically just for private credit. This is just to give you a broader picture first. If we look at this chart, we can see that commercial banks have really stepped up their lending. They've been steadily ramping up their lending since around 2024 through to 2026, increasing loans at a remarkably rapid and aggressive pace. The total amount of lending has effectively doubled in size during this period. Out of that $1.8 trillion, about $500 billion was lent specifically to private credit. The rest went to things like hedge funds, private equity, real estate investment trusts, and various other similar financial entities. So let's try to estimate, just for fun, how much commercial banks that lend specifically to private credit, let's say the $500 billion, would be affected if private credit were to default at around 15%. How much could commercial banks potentially lose at most? I'll use the Blue Owl case as an example again. As I mentioned, Blue Owl took a hit from a forced sale of 30% of its $1.4 billion portfolio that had to be returned to investors. That means that 30% would have to be sold by Blue Owl at a discount. So if commercial banks lent $500 billion to private credit and faced a forced sale at the same rate, about 30%, it means commercial banks could potentially lose around $150 billion from the loans given to private credit. Is that a lot? Yes, it is. But let me emphasize again, these are just hypothetical numbers, completely made up. Like I just invented them myself. They're not real. But what is actually happening is that since the start of 2026, the financial sector index in the United States has been moving in the opposite direction of the S&P 500. The S&P 500 keeps climbing, but the financial sector index has been dropping. Still, I have to say, this doesn't mean it's going to keep plunging straight down. It might be dropping just to wait and stabilize, you know? Maybe it's waiting for something to break a little, and once everything settles down and things are in order, its health will improve and it could bounce back. That could be the case. At this point, you might say, oh, I still feel like private credit is going to collapse, software is going to fail, or commercial banks are going to go under, but that has nothing to do with me. Think again. Let's connect the dots here. Private credit lends to software companies, right? And who lends to private credit? It's the commercial banks, the big players who lend to private credit, right? And if you ask, where do commercial banks get their money from? Well, basically, it's from the deposits of regular people, or from selling products to retirement funds, pension funds, insurance companies, sovereign wealth funds. And who invests in these funds? It's pretty much regular people like us. But I don't want you to worry too much, because everything I've explained so far, UBS. There are predictions that private credit could have a default rate as high as 15%, but some people think that's not true. For example, Mike Arougetti, CEO of Aris Management, said that UBS's prediction that the default rate for private credit could reach as high as 15% is completely wrong. It's impossible. Arougetti said that even during the subprime crisis in 2008, the private credit default rate was only around 8 to 10%. If it really went up as high as 15%, then all the assets in the entire portfolio would collapse and the whole economy would be ruined. Hearing that makes me feel relieved. Oh, it definitely can't be true. So to sum up this clip, if UBS is wrong, that's good. But if UBS is right, it means that the next financial crisis won't come from the housing market for sure. It will come from somewhere else. AI instead, it will become the new source of bad debt crisis.